Hello friends, welcome you all. The last week we've been listening about a lot of news about the US banking sector, especially the Silicon Valley Bank and the Signature Bank. Both have collapsed and there's a lot of panic across financial markets across the world. So what exactly has it happened? In fact, many people have already started comparing it with 2008 global financial crisis. Is it really so bad, and why is it that things are happening now, and what is the cause for this meltdown? So let's understand this in detail in this video. So before getting into SVB bank, let's understand how a bank works. We all understand that, I'm sure we all have a bank account. So assuming I have a bank account with say ICICI Bank, so I go and deposit my money with an ICICI Bank, say savings account, I get 3%. Assuming I have a FD, in today's rate I get about 7% or so. But if I go to the same bank and borrow money, say a personal loan or a home loan, the rate is anywhere upwards of 9% to 12%, which means the difference between the deposit rate and the lending rate is where the bank makes money. So now let's understand what SVB was doing. So SVB is a Silicon Valley bank. Basically, the customers were all startup companies. So these companies used to raise money whenever things are good, and they keep looking for opportunities to invest in some of the upcoming businesses. But as startup world was raising a lot of capital, the startup companies had a lot of money, and when they were actually trying to deploy those in the opportunities were actually coming down because of the US slowdown in the economy, which resulted in very less opportunity to invest. So the startup world decided to park their excess money in a bank, which is SVB. So as a lot of money kept coming into the bank, and bank also did not have enough opportunities to lend, so what they did is they actually started investing the money received in the depositor's account in a US Treasury bond. By nature, US Treasury bond is one of the safest in the world, so there is nothing to worry when it comes to the instrument. But where it went wrong is, the bonds which they had invested, they were all on a very long-term basis, which means they were investing with a 10-year, 20-year, 30-year kind of maturity bonds. I think that is where the trigger is. So to understand why this trigger happened, we need to understand a little bit of how the bond market operates and what is the relationship between the interest rate and the bond market. So we all know that from April 22 onwards, across the world there has been inflation. And the inflation has been at a decadal high for many countries, including US and Europe. Of course, even in India we had inflation, but the inflation was not as high as what they had. So to curtail inflation, most federal banks were actually increasing rates. So in April 2022, US had a interest rate of close to about 0.5%, which is 0.5%. From there, as we speak today, they have increased the rate to 4.75%. In the same period, India from 4% has moved to 6.5%. So let's understand this a little more better, because the complexity of the problem lies in the pace of rate hikes. So from 0.5%, if the interest rate goes to 4.75%, which means the difference is about almost 4.25%, which is almost 850% from the low, which is one of the most steepest and the fastest increase ever in the US federal rate. So that actually triggered a lot of panic. Whereas in India, from 4% it went to 6.5%, which means it's an increase of just about 62% or so. So let's understand how the bond market reacts. So whenever the interest rate goes up, the bond prices actually falls. So it is inversely correlated. So let me explain this with a very simple example. Assuming I had say 1 lakh rupees in April 2022, I approached the ICICI Bank and I said I have 1 lakh rupees, I want to park a fixed deposit. So they said, yeah, you can park it, the interest rate is 5%. So in December 22, say about 6 months from then, I again had 1 lakh rupees to invest. So I again went to ICICI Bank and I asked, I want to park my money, and they said, now the interest rate is 6%, you can park. The same happened in March 23 when I went to ICICI Bank. They said now the interest rate is 7% and you can park it. So which means as we speak, I am holding 3 different bonds of 1 lakh each with 3 different interest rates. So the initial rate was 5%, then it is 6%, and now it is 7%. So now, as an investor, assuming you have a choice to buy the bond from me, which one will you choose? Naturally, you will choose the bond which gives you the highest interest, right? Which means the bond with a 7% interest looks a lot more better compared to the other bonds, which is the 5% and the 6%, which means naturally those bonds will trade at a discount to the 7% bond. So that's what exactly happens when the interest rate keeps going up, the bond prices keeps falling down. So a 7% bond has a higher price compared to a 6%, compared to a 5%. So this is what exactly happened. So let's go to the SVB now. So as they started pushing their money towards the US Treasury bonds, which is safe by nature, but these are long-term bonds. So as the rate kept increasing, so they would have parked the money at say 0.5%, 1%, 2%, but the rate has actually gone up to 4% and 4.5%. So as the rate started going up, the bonds which were locked at a lower rate started trading at a discount. And since the opportunity for the startup world was diminishing because they were not able to raise newer capital, what they did is they actually wanted to start using the existing deposit. So they actually started coming to the SVB bank and they started withdrawing money. And as they started withdrawing money, naturally beyond a point, SVB had to sell some of the bonds which were trading at a discount, which actually created a 1.8 billion worth of loss. So as the news started spreading, more and more depositors started taking out money, which resulted in huge panic, and eventually the bank has to shut. So this was more a problem to do with the implementation and the risk management, because the whole world knew that the interest rates are going to go up, but somewhere the bank totally missed it, and maybe the regulator also really did not spend too much time in terms of where the money was getting invested. In fact, SignatureBank was also investing in some cryptocurrencies, which is a high volatile asset. Whenever the depositors need money and you want to try and sell, if it is at a loss, naturally you will have to book a loss. So this triggered a huge run on the bank, and eventually these banks have to shut. So currently as we speak, the regulators and the government, the US government, are on the job. So they have assured depositors that the money will be safe. But naturally the sentiment is very bad, and this can actually have a spiraling effect. So now the $1 million question is, will it affect Indian banks and the Indian banking sector? Of course, sentimentally yes. So that's one of the reasons even our equity markets have been falling, and especially the bank stocks have been falling. But the quantum of rise, as I explained earlier, in US it was a 850% rise, whereas in India it is a 62.5% rise, which means the quantum of rise in India is definitely not as high as US, which means our problems are much lesser. But of course there is sentimental problem, because of which market is taking time to readjust. And also the regulatory house, which is the RBI of India, they have been always very cautious when it comes to parking money and lending money. So the compliance and the risk part in India is showing to be much more superior than what is in US. So which means our banking sector seems to be a lot more stable than the US. So from an investor point of view, since because of this panic, there is a lot of opportunity which is getting evolved in the equity market, which means as investors, maybe these are very panic times, but you are actually getting something at a reasonably at a good price to actually enter. So as Warren Buffett says, be fearful when others are greedy, and be greedy when others are fearful. So we are in that situation where most of us are fearful. So today is the time actually to start accumulating. Maybe the next couple of months or quarters can be very disturbing, but eventually somebody who is coming with a 3-4 year 5-year view hopefully should actually make money in the current situation. Also, since the rates have started going up, even the short term parking in debt funds are actually very lucrative. So even if you have money for say 3 months and 6 months and 1 year, your returns are actually close to 6 to 7%. So if you are holding excess money in your savings account, maybe it's a great time to actually move some part of the money into short-term debt, which can actually give you at least 2 times more interest than the savings account, with a lot more flexibility. So to summarize, the sentiment is really bad, but hopefully since the regulator and the governments are on the job, hopefully this will tide down and hopefully things will become better in the coming years. But we'll have to closely watch what's going to happen with the other banks, especially in US and also in Europe, because even Europe has seen a lot of interest rate hike. So we'll have to really keep our fingers crossed. But when it comes to India, broadly we are safe and secure. Hope you enjoyed this video. Thank you for watching.